These gains coming partly on the back of the S&P 500, which climbed above 1,000 for the first time since November. Zara Burton in New York has more on this question. Zara, quite a day. How broad-based was this?
Very broad-based, in fact, because all of the 10 major industry groups in the S&P 500 moved higher for the day. You're talking about gains over in commodity producers, material and energy stocks. Among the three best-performing groups in the S&P 500, oil, of course, getting above $71 a barrel, very bullish for a lot of the energy groups, and also the highest level we've seen for oil in about 7 weeks. Now, financials, they rounded out the top three. Wells Fargo, JP Morgan on that list, as well as some of the regional banks. We're talking about KeyCorp, as you can see, and Zions Bank Corp as well. This after HSBC over in Europe, of course, that's Europe's biggest bank, I should say, posted a profit in the first half of the year, signaling that the financial markets are recovering. Now, we also have those better than expected reports on manufacturing and construction spending. Of course, news about the economy. That's also fueling this idea that the economy is bouncing back, and that's getting buyers back into the market, Paul.
Also, we have the issue of the economy. Of course, that has to underpin earnings growth, which underpins the market in the long run. We may get sluggish growth. That affects pricing power, but it affects pricing power in different ways. What is that saying about the stock market?
Okay, let's talk about the weak economy, because the upside of a weak economy is that wholesale prices actually paid by companies are actually falling. Now, this decline in prices that we've been seeing may just be the thing to get U.S. companies back on their feet. And here's what we're talking about. If you look at wholesale costs, they actually declined by about 4.6%, as you can see in this chart, and this was in last quarter, and that outpaced the drop in consumer prices. This is what consumers are paying for their goods, and this is by the most we've seen that in about 7 years. If you think about the drop in oil, if you think about the drop in natural gas prices compared to last year, oil about half of what it was in the 2Q of last year, two huge input costs for many of these companies. And so that gap between input costs and consumer prices, that's seen as a gauge of company pricing power, what they can charge consumers. And that indicator is more than double the 6-decade average. And the last time that we actually saw that, September 2002. If you look at this chart, a very, very bullish chart, the S&P actually took off in the following month when we got to that 2002 mark in September. Now, of course, the critics, of course, are saying the improvement in earnings, it's not going to last as companies run out of ways to cut costs. There's only so much cost that you can cut out of the system. Don Wardle, he's one of those, and he's a fund manager over at Ridgeworth Capital Management. And he was saying that lower costs, they're not going to support earnings or stock prices unless sales also increase. This is a problem we've been hearing about, sales not increasing in the second quarter. We'll see what happens in the quarters ahead. But of course, the GDP number came in much better than expected last week. So that could fuel some of the sales pictures. And of course, if you look at the stock market, it came up to 1,000 today. You would think maybe that is a psychological benchmark that people are actually going to fuel these gains and be more optimistic about future gains, Paul.
Yeah, could be off to the races from here, but you never know. If you look at that last chart, it was basically a big multi-year run-up to a bubble which burst and wiped out all of those gains. But who knows?
That's right.
Zara, thank you for that. Zara Burton in New York.